Okay, so you want to own a casino. Slot machines blinking, blackjack tables packed, hotel towers full, money landing in the cage every minute. In 2023, United States commercial gaming revenue hit about $66.5 billion, and 2024 ran even higher. But here is the shock. Las Vegas Strip casinos recently made only about $154 million in net income on $21.1 billion of revenue. That is roughly a 0.7% margin. So the real story is licensing, comps, debt, labor, taxes, and why the biggest profits often come from everything around the casino floor. A casino floor is usually the centerpiece of the brand, but it is no longer the whole business. Modern casino resorts are built like small economies. The same guest who loses money at a roulette table may also pay for a hotel room, a steakhouse dinner, a concert ticket, a nightclub table, a convention badge, parking, shopping, and resort fees. The casino gets multiple chances to earn from the same visit, even before a single chip is placed on felt. The Las Vegas Strip shows this clearly. In a recent year, gaming made up only about 26% of total Strip revenue. That means roughly three-quarters came from everything outside gambling: rooms, food and beverage, entertainment, retail, conventions, and other resort operations. This is why the accounting terms matter. Gross gaming revenue is not the amount people wager. It is what the casino keeps after paying winning bets. Total revenue adds the rest of the resort. Earnings before interest, taxes, depreciation, and amortization is a rough measure of operating profit before major financial costs. Net income is what remains after expenses, debt costs, taxes, and accounting charges. So when someone says billions were wagered, that does not mean billions became profit. The house edge may be real, but the casino still has to operate a hotel, staff restaurants, book shows, finance buildings, comp valuable players, and pay regulators. Which raises the real question: if the house edge is mathematically guaranteed, where does all that money disappear? The first cost of owning a casino is not the roulette wheel, the slot machine, or the carpet. It is permission. At the smallest end, an owner might run a local card room, a limited gaming venue, a slot route inside bars, or a small neighborhood slot hall. That can sound modest, but it still requires gaming licenses, background investigations, approved equipment, surveillance, security, accounting controls, cash reserves, and a location that regulators will accept. Even before opening day, the owner may be paying lawyers, consultants, rent, payroll, and licensing fees while waiting for approval. A mid-tier regional casino is a different machine. Now the project may include a hotel, several restaurants, a parking structure, a loyalty program, marketing staff, a surveillance room, cage operations, and hundreds or thousands of gaming positions. The casino is no longer just buying machines. It is building a controlled financial environment where every chip, ticket, promotion, jackpot, and cash transaction has to be tracked. Then there is the integrated resort. At that scale, the casino floor may be only one part of a multi-billion-dollar development. Land, construction, hotel towers, arenas, convention space, restaurants, utilities, roads, parking, design fees, and financing costs can push the budget into a category closer to an airport terminal than a gambling hall. Scale changes the risk. A small operator needs enough capital to survive regulation and early losses. A regional casino needs steady traffic and disciplined operations. A mega resort needs years of financing, political support, and a market large enough to fill rooms long after the ribbon cutting. Getting the building open is only the beginning. The harder part is getting permission to operate it. A casino license is not a form you file at City Hall. It is a permission slip for handling large amounts of cash, extending credit, monitoring gamblers, and operating games where the public has to trust the outcome. Regulators do not only examine the company applying, they investigate major owners, board members, executives, key employees, lenders, and sometimes investors with meaningful influence. They want fingerprints, tax records, business histories, litigation records, criminal checks, financial statements, and explanations for where the money came from. If the capital stack includes private equity, debt funds, wealthy families, or overseas entities, the review can become a map of every person behind the money. This is expensive before a single bet is placed. The operator pays application fees, gaming lawyers, accountants, compliance consultants, background investigators, and internal staff who prepare the filing. Then come the systems, anti-money laundering controls, know your customer procedures, suspicious activity reporting, independent audits, surveillance standards, cash handling rules, and regular reports to the Gaming Commission. The reason is simple. A casino can be used to launder money, hide ownership, influence local politics, or exploit customers if controls are weak. Regulators are not just approving a business, they are deciding whether the people behind it are suitable to run a cash-heavy financial operation in public. That is why, in many markets, the most valuable asset is not the casino building. It is the scarce license, the protected territory, or the legal right to access that market. Survive the investigation, fund the compliance machine, and secure the permission. Then the next problem begins. The casino still has to buy customers. Buying customers in a casino does not look like buying ads. It looks like free hotel rooms, steakhouse dinners, drinks, show tickets, cashback, resort credits, airport transfers, and a host who knows when a valuable player lands. These are comps, and they are not random acts of generosity. A casino tracks how much a player bets, what games they play, how long they play, and the house edge on those games. From that, it estimates the player's theoretical win, the amount the casino expects to earn from that customer over time. If a blackjack player is expected to generate $10,000 in theoretical loss across a trip, the casino may decide it can reinvest a meaningful slice of that value to keep the trip happening again. The free suite is not free. It is a customer acquisition cost with better room service. Loyalty programs turn this into a machine. Every card swipe builds a profile. The casino learns which offer brings a customer back, whether they respond to cashback, food credit, tournament invitations, or VIP treatment. The best customers may have personal hosts negotiating perks trip by trip. The danger is volatility. A high roller can demand private jets, luxury suites, credit lines, and exclusive events, then win big over a weekend. On paper, the math still favors the house. In a single month or quarter, that same customer can turn into a very expensive loss. And the customer is only the first expense. The operating machine built to serve them costs even more. Start with payroll. A casino resort never really closes, so it has to staff the building every hour of the day. Dealers, slot attendants, bartenders, cocktail servers, hotel clerks, housekeepers, cooks, security guards, surveillance teams, accountants, information technology staff, compliance officers, and managers all sit on the cost side before a single jackpot is paid. That labor bill is different from a normal hotel or restaurant because gambling adds specialist jobs. Table games need trained dealers and floor supervisors. The cage needs people handling cash and chips under strict controls. Surveillance rooms watch the floor continuously. Compliance teams file reports, monitor suspicious activity, and make sure the casino keeps its license. Then come the taxes. Casinos may pay gaming taxes on gambling revenue, hotel taxes on rooms, sales taxes on food and retail, local fees, license renewals, and required contributions to tourism boards or community funds. The exact burden depends on the market, but in some places, the government effectively becomes one of the biggest partners in the building. Debt can be even heavier. Modern casino resorts are often billion-dollar construction projects with hotel towers, theaters, convention space, pools, restaurants, parking structures, and gaming floors. If that project is financed with borrowed money, interest expense becomes a permanent drain. On the Las Vegas Strip, operators have reported billions of dollars in annual interest costs across major properties. Suppliers take another slice. Slot machines may involve purchase contracts, leases, or revenue sharing. Table games can carry licensing fees. Food distributors, beverage companies, entertainers, linen services, software vendors, payment processors, utilities, and insurance companies all send invoices. The The building itself also demands constant reinvestment. Rooms age, carpets wear out, restaurants need redesigns, gaming systems need cybersecurity upgrades, and competitors keep raising the standard. A casino can post enormous revenue and still watch profit leak through payroll, taxes, interest, vendors, and maintenance before owners see the final number. Even after all those costs, the biggest danger is that casino revenue is not smooth. The math favors the house over time, but time can be expensive. A few baccarat whales can win millions in a weekend. A sportsbook can get crushed if popular teams all cover the spread. A run of jackpots or high-limit table losses can turn a strong month into a weak one before management has time to react. The larger risk is that customers can disappear faster than the building can shrink. A new casino across town can split the market. Online betting can pull casual gamblers onto their phones. A recession can cut vacation budgets. A pandemic can close the floor completely. Convention cancellations can empty hotel rooms, restaurants, bars, and table games at the same time. Then there is the risk that does not show up on a normal income statement, the license. Casinos operate only because regulators allow them to. Failures around anti-money laundering controls, underage gambling, responsible gambling rules, cheating investigations, or political backlash can lead to fines, forced oversight, or in extreme cases, the loss of the right to operate. That is why the best casino companies do not treat gambling as a magic cash machine. They build systems that can survive bad luck, weak tourism, and regulatory pressure. The real business is not just taking bets, it is engineering enough profit centers that one bad streak does not sink the entire property. The strongest operators think about the entire wallet, not just the wager. A guest might lose at blackjack, pay for a suite, buy dinner, see a show, shop in the lobby, attend a conference, and come back next month because the property made the trip feel personalized. That is where loyalty data becomes the control room. Every card swipe, room booking, restaurant charge, and slot session helps the casino estimate a customer's lifetime value. That estimate decides who gets a free room, who gets a steakhouse credit, who gets a private host, and who should simply receive a discounted weekday offer. Land is the other engine. A casino can anchor a resort, revive a district, support a tribal enterprise, fill a cruise ship, or turn a regional highway exit into an entertainment hub. The building is not just where bets happen, it is a machine for capturing time, movement, and spending. After the glamour, the question is simple. Can this property create more lifetime customer value than it burns in overhead? That is the real twist. Owning a casino is not just owning the odds. It is owning a regulated, capital-heavy, 24-hour hospitality machine. License scarcity, customer data, and non-gaming revenue have to outrun taxes, comps, debt, labor, and volatility. Thanks for watching. Comment which business you want analyzed next.